Welcome again, students. And last week we had a very interesting session from Professor Naman Desai. Thank you very much for your kind feedback. And we are once again here with Professor Naman Desai, who will be starting the second session in his series on leadership ecosystem building for entrepreneurial leadership. Thank you, Professor Naman Desai.
Thank you. So good afternoon, everyone. So if we think about the session from the previous week, we talked about understanding how to prepare financial statements, how to understand record, how to learn how to learn how to record transactions that a company typically enters into during a typical operating year or an operating quarter, right? So the focus was on understanding the process of preparation of the financial statements and get an idea of how this accounting system of debits and credits work, right? So today we are going to shift our focus a little bit and focus more on an entrepreneurial topic, okay? So if anyone is planning to start a business, typically, what is the first thing that they would like to know? If you want to start a business, the first thing that I would like to know is, what are my sales? What are my costs? How do my costs behave based on my sales levels or production levels? And most important, when will the company hit break-even point? Break-even point is the point at which my total sales are equal to total costs. And beyond the break-even point, when will the company start making profits? Okay. And we are going to focus on these important concepts in today's sessions. Okay. Now, today, the first thing I want to introduce is this concept of cost behavior. And we are going to talk about cost behavior in terms of fixed versus variable costs, okay? We are going to think about cost behavior in terms of fixed versus variable costs. When it comes to these fixed costs, let me just quickly share let me just open the thing. So when we think about these cost, as I said, the most important cost behavior or the behavioral cost classification that we need to worry about is the bifurcation of costs into fixed versus variable. Okay. So when we talk about fixed cost, what are these fixed costs? Okay. So if we want to draw a graph, a typical fixed cost graph is going to look something like this. Okay. Fixed costs are costs which do not change within your installed capacity or your relevant range. Okay. I will give you a very simple example. Let us say you have a machine on which you can make 10,000 units. Okay. Once you buy the machine, you will have to bear all the costs of that machine, irrespective of whether you make 0 units, 5,000 units, 1,000 units, or 10,000 units. Okay. So within that installed capacity of 10,000 units for this particular machine, the fixed costs are going to remain unchanged. Okay. Beyond this installed capacity, the fixed cost will not grow in a linear manner or in a direct manner associated with your usage, production, or sales. But the fixed costs are going to jump exponentially because remember, once you hit your full installed capacity of 10,000 units, beyond that point, you can't buy 1/4 of a machine or 1/5 of a machine. You have to buy a whole new machine. So beyond the installed capacity, the fixed costs are going to jump exponentially. Okay, they are going to go up vertically. And then again, they are going to remain unchanged within your new installed or installed capacity, or what we call our relevant range. Okay. So this is what we mean by fixed costs, right? They do not change within installed capacity or relevant range. Examples are lease payments, rental payments, salaries you pay to some of your staff members, which you have to pay irrespective of whether they work or not in the company, right? So these are what we mean by fixed costs. Also, fixed costs introduce a lot of rigidity and risk in your business model. Okay, because remember, once you pay for these costs, you cannot avoid them in the short run, irrespective of what are your sales and production levels. Okay, irrespective of what are your sales and production levels. On the other hand, we have variable costs which vary in direct proportion with your output. You know, whatever is your output could be it could be measured as your total sales, output could be measured as your total production, whatever. Okay, but these costs, they vary in direct proportion with your output. What do I mean by direct proportion? It's like, you know, if you produce and sell more, you have to spend more on these costs. If you produce and sell less, you have to spend less on these costs, right? Example is your factory labor, your direct materials that go into the making of your product, right? So the usage of these items is dependent on your level of activity. If your activity level increases, it will increase in a linear fashion with your activity. Okay, fine. See, in a perfect world, I would like to run a business with high variable costs and very low fixed costs. Okay, because with the variable costs, I can constantly change my business model depending on prevailing economic conditions. But with the fixed costs, remember, once I pay for these fixed costs or invest in these fixed costs, my future course of action, at least in the short run, is sort of pre-decided, and I cannot change my company's production model or business model in response to prevailing economic or business conditions. Okay, so this is what we mean by understanding the behavior of costs. Certain costs do not change within our installed capacity. These are fixed costs. And certain costs change in direct proportion with our activity levels, which are our variable costs. Okay. Now you might say, okay, I know what is fixed, I know what is variable, but why is this classification important? Okay. And as I said at the start of the class, today we are also going to conduct one of the most basic analysis which any businessman does before starting his company or his business. Okay. See, before you start anything, you want to know what are going to be your sales, what are going to be your costs, and at what point will the company break even. Okay, so at what sales level will the company eventually recover all its costs? Because beyond, only if our sales are going to go beyond that point will the company actually make a profit. Okay, so one of the most primary analysis that any business owner does is to calculate the break-even point for our sales. Okay, and break-even point is the sales level at which total cost is equal to total sales and your profits are zero, right? Because remember, once we estimate our expected sales and cost structure, if the company is not going to, if the company's sales are not going to exceed the break-even point, then there is no point in conducting a business like that. Because, you know, if the company is not expected to achieve break-even, the company is never going to make profits and it will be constantly running in losses. And the entrepreneur, rather than making money, would be losing money. Okay, right? So we need to understand cost behavior to be able to calculate the break-even point. More specifically, we need to bifurcate the costs into fixed and variable components to be able to apply the break-even point formulas that we are going to talk about. Okay, so we need this cost classification to conduct this most fundamental analysis. Okay. Now, for a single product company, let us say a company is selling one product. Okay. And of course, we are going to look at examples as we go along. Your break-even point is going to be your total fixed costs divided by contribution margin per unit. Okay. Break-even point is going to be total fixed cost divided by contribution margin per unit. Okay. Now, when we talk about contribution margin per unit, what do you mean by contribution margin per unit? The contribution margin per unit is nothing but your selling price per unit minus the variable cost per unit. Okay, so contribution margin is nothing but your selling price per unit minus the variable cost per unit. Okay, the contribution margin contributes towards recovering fixed costs till you reach break-even point, and beyond the break-even point, it contributes towards profits. Okay, so till you hit break-even point, the contribution margin helps in recovering the fixed costs, and beyond the break-even point, the contribution margin contributes towards the profits of the company. Fine. So, as I said, if you don't know which costs are fixed or which costs are variable, you cannot calculate the break-even point of the company, and that would be a disastrous thing to do, as I said, because if you are not expected to hit break-even point, you should not get into a business like that. Okay, you should not get into a business like that. Fine. All right. So let us look at a couple of examples where we calculate the break-even point of a company. So I have prepared some simple examples for you over here. Okay, so we have a company which manufactures specialized tin cans. Okay, we have a company which manufactures specialized tin cans. The direct material, the variable cost associated with the manufacturing of our tin cans are given to us. Okay, so material is $6, 6 rupees. Direct labor is 8 rupees. Other manufacturing expenses is 2 rupees. And the total variable costs are 16 rupees per can. Okay. The fixed costs, so these are the costs that vary in proportion with the number of cans produced. Okay. On the other hand, these costs do not vary in proportion with the number of cans produced. Okay. For example, once we rent out the factory, whether we use the factory or not, or whether we use it to its maximum potential capacity or use it at half capacity, the rental costs are still going to remain unchanged. Okay. Depreciation expense on machine, right? The same thing. Once we buy the machine, irrespective of whether we use the machine or not, the costs are going to remain the same. Fine. So these are all our variable costs, and these are all our fixed costs, right? The variable costs depend on how many cans are manufactured. The fixed costs are not dependent on how many cans are manufactured. We have to pay them irrespective of our level of production. The selling price for each can is 20 rupees, and my current sales are 50,000 cans. Okay, my current sales are 50,000 units. Okay. Now, based on this, I want to calculate the break-even point of the company. I want to calculate the cash break-even point. I want to calculate sales to earn a desired profit after paying tax of 20%. And I want to calculate the margin of sale. Okay, I want to calculate the margin of sale. Okay, fine. So consider this. Okay, this is your new business plan. Okay, you are planning to start this new manufacturing facility, and all this information has been given to you before you start the production of your cans. And you want to first decide, is it even worth taking up this venture or not, right? Is it even worth taking up this venture or not? So let us calculate the break-even point. We know that the total fixed cost of this company are 1,80,000 rupees. The contribution margin per unit is the selling price minus the variable cost. And that, you remember, the selling price was 20 rupees. The variable cost was 16 rupees. It is given to us over here. Selling price is 20 rupees. Variable cost is 16 rupees. And so this comes to rupees 4 per unit, right? Contribution margin per unit comes to 4 per unit. And so my break-even point is going to be my total fixed cost divided by the contribution margin per unit, which is going to be 45,000 units. right? Which is going to be 45,000 units. Okay, right? So now I know one thing, that if I start this new factory, my sales are expected to be 50,000 and I am breaking even at 45,000. Okay, which means that, you know, I am going to make a profit if I start this business, because my sales, I will recover all my costs at a sales level of 45,000 units, and my actual sales are 50,000 units. My actual sales are 50,000 units. Okay, so now we know that, okay, it is profitable to start this company. Now the next thing I want to calculate is the cash break-even point. Okay, now in the cash break-even point, I will only consider my cash costs. Okay, remember, your depreciation expense, out of all these costs that are given to us, all of them are cash costs except depreciation on machinery. Depreciation on machinery is not a cash cost. It is something that we call an allocated cost, okay, which is allocated over the lifetime of the machinery. Just remember this, machine depreciation is a non-cash fixed cost. Okay, machine depreciation is a non-cash fixed cost. Okay, so now I will first calculate all my cash costs. So my total fixed cost is 180,000. The non-cash fixed cost, which is my depreciation, is 30,000. It is given to us over here, right? So my total cash fixed costs that are to be recovered each year is going to be 1,50,000 rupees. Okay, total cash fixed cost to be recovered each year is 1,50,000 rupees. Again, I know that my contribution margin is going to be selling price minus the variable cost, right? Selling price minus the variable cost. Right? And so my cash break-even point, therefore, which is going to be the total cash fixed cost divided by the contribution margin per unit, is going to be 37500 units. Okay, right? So what I am telling you over here is that to recover all my costs, cash and non-cash, I need to sell 45,000 units. But to recover only my cash outflows, I need to sell only 37,500 units per year. Okay. So again, both these numbers tell me that, look, my expected sales are going to be greater than my break-even, total break-even point and cash break-even point sales. And so it is profitable to undertake the production of this tin can. Okay, fine. Now, the break-even point is fine. Okay, now I know what my target is to break even. But eventually, remember, all companies want to make a profit. Okay, eventually, all companies want to make a profit. Okay, we might all have an expected profit number in our mind when we start any business venture. Okay, so now I also want to identify the sales level that is required to earn our desired level of profit. Okay, so for that, again, we have a formula. Sales to earn desired profit is your total fixed cost plus desired profit divided by contribution margin per unit. Okay, so sales to earn desired profit is your total fixed cost plus desired profit divided by contribution margin per unit. Okay, now in this problem, it is mentioned that I want to make a profit. My desired profit level is 40,000 rupees. Okay, my desired level of profit is 40,000 rupees. But Remember, we have to pay taxes, right? When we make any income or profits, we have to pay taxes to the government. Okay. And this, I want to make this profit of 40,000 after I pay a tax of 20% to the government. Okay. Remember, when I make a profit, I have to pay taxes to the government, right? And so to make this profit of 40,000, so I want to make this profit of 40,000 after paying taxes of 20% to the government. Okay. So if I want to make a profit of 40,000 after paying taxes to the government, then profit after tax, the profit before tax, therefore, has to be 50,000. Okay. Which is your profit after tax. Right? Profit before tax is going to be your profit after tax divided by 1 minus the tax rate. Okay. So if I make 50,000, I will then pay tax at the rate of 20% on that 50,000, which is 10,000. And I will be left with my desired profit of 40,000 rupees. Okay. So to calculate my pre-tax profit, I take the profit after tax and divide it by 1 minus the tax rate. Okay. So I know that my total fixed costs are 180. The fixed cost plus desired profit is going to be 230, 50 plus 180. The contribution margin still remains at 4 rupees. And so the sales to earn a desired profit of 40,000 after tax or 50,000 before tax is going to be 57,500 units. It is going to be 57,500 units, right? So again, I find out something important over here. Yes, my expected sales are going to be 50,000 units, which will allow me to break even. But it will not allow me to earn this target profit level, because to earn that profit, I have to actually sell 57,500 units. Okay. I have to actually sell 57,500 units. Okay. Fine. So now you see, based on this understanding of fixed cost and variable cost, we have taken so many important decisions, right? We first estimated what this new company is going to make, what are its costs, what are its expected sales, what is its selling price. And based on all those numbers, we told the owner of the company that, look, your expected sales are 50,000, you will break even at 45,000. So your company will not run in a loss. Okay. Then we told him that, to recover all your cash fixed costs, you need to sell 37,500 units, which is again less than your total sales. That means, you're going to recover all your cash fixed costs. Finally, we told him that, look, if you want to make a before tax profit of 50,000 rupees, you have to sell using our formula, sales to earn desired profit is equal to total fixed cost plus desired profit divided by contribution margin per unit. Based on this formula, you will actually have to sell 57,500 units. So if you are expecting this profit level, this business is not going to give you the expected profit level, because instead of selling 57,500, you are only expected to sell 50,000 units as of now. You are only expected to sell 50,000 units as of now. Okay, fine. And the last thing I want to calculate is this margin of safety. Okay, your margin of safety is going to be your total sales minus break-even point sales. Okay, margin of safety is going to be total sales minus your break-even point sales, which is going to be 5,000. Which is going to be 5,000 units. Fine. And as I said, before you start any business, even the biggest promoter or company owner does this analysis. Okay, they understand the behavior of their costs, they calculate the break-even points, they calculate the sales to earn desired profit, they calculate this margin of safety, which tells them how far their actual sales are from breaking even. Okay, they calculate this cash break-even point and so on. Okay, fine. All right. Now, let us look at a couple more examples to refresh this concept. So, I'm going to give you some delicious examples. So I'm going to now take you to a pizza making restaurant, and we are going to help the restaurant owner calculate the break-even point for his restaurant. Okay. So it says that, a restaurant makes thin crust pizzas and the selling price per pizza is 200 rupees. The variable costs are flour is 10 rupees, shortening is 5 rupees, cheese is 30 rupees, condiments on the pizza like whatever, ketchup or whatever, sauces and all is 10 rupees. The chef time is 10 minutes at 120 rupees per hour, and the cost of oven electricity is 5 rupees per pizza. Okay, so these are the costs that are going to depend on the number of pizzas made. Okay, these costs depend on the number of pizzas made. The monthly fixed costs, these are the costs that are not dependent on the number of pizzas made. Okay, so whether I make 100 pizzas or 200 pizzas or 1000 pizza, these costs are going to remain the same. These costs are going to remain the same. Okay, and based on this, we want to calculate the break-even point of our pizza restaurant. Okay, we want to calculate the break-even point of our pizza restaurant. So let's see. Fine. So we know that the selling price is going to be 200 rupees, and my all these are my variable costs. All these are my variable costs, right? The cost of the chef is going to be, remember, the total cost per hour is 120 rupees for 60 minutes. Each pizza takes 10 minutes worth of chef time. So that cost comes to 20 rupees, right? And so the contribution margin per pizza comes to 120 rupees per pizza, right? This is per pizza, right? So this is my contribution margin per pizza. I sell it at 200 per unit. These are the variable cost. Contribution margin is 120 per pizza. The fixed costs are as follows, right? They are given to us. The total fixed cost comes to 85,000 rupees per month, right? And so the break-even point, which is the total fixed cost divided by the contribution margin per unit, is going to be 708.33. Okay. So now we can tell the restaurant owner that you should operate this restaurant only if you are going to sell more than 709 pizzas. If you are selling less than 709 pizzas, it doesn't make sense in running this restaurant, right? It doesn't make sense in running this restaurant, right? You should operate this only if you make more than 708 or 9 pizzas. Otherwise, the restaurant is going to run in a loss, right? This is a very important piece of information for you to start a restaurant, right? Because if you find out that the demand for your pizzas is never going to cross 708 pizzas, then it is not worth operating that restaurant. You are better off doing something else, right? You are better off doing something else. Fine. So this is the basic break-even point analysis. Now, a lot of times what happens is that a company will not sell a single product. Okay. A company, instead of selling a single product, could be selling multiple products. Okay. So let us look at the second example here. Okay, so we'll stick to our pizza example. Right, so we have a restaurant which makes 3 different types of pizzas: thin crust, hand tossed, and deep dish. Okay, the selling price for each of the pizzas is given, the variable costs are given, the monthly sales are given. Okay, the monthly fixed costs are given now, and I want to now calculate the break-even point for this restaurant. Now, if you think about our first 2 examples, these companies were making a single product. Okay, they were making only one product. Now we have a company which is making multiple products. Okay, we have a company which is making multiple products, and I want to calculate the break-even point of a multi-product company. So the basics remain the same, but the approach will be, the way we set up the problem is going to change a little bit. Okay. So we know that these are going to, so I'm going to first calculate the selling price, variable cost, and contribution margin. Okay. So we know that for thin crust pizza, the contribution margin this is selling price minus variable cost gives us the contribution margin. Okay. Now, we know this is the per unit contribution margin for thin crust, hand tossed, and deep dish. Okay. Now, rather than calculating the break-even point for a single product, remember here we have a basket offering, right? We have a combination of thin crust, hand tossed, and deep dish pizzas being sold by the company. So I will now calculate the break-even point of the entire product mix. Okay. So I will now calculate the break-even point of the entire product mix. And so contribution margin per unit multiplied by the product mix will now give us the contribution margin of our entire product mix. Okay, so we are going to set it up slightly differently. Now we know that for each of these products, we sell 800 thin crust pizzas, 600 hand tossed pizzas, and 200 deep dish pizzas. Okay, so we know this is going to be our product mix, right? This is our product mix. So this is going to be our contribution margin of the product mix. Okay, fine. So contribution margin per unit multiplied by number of units in the product mix gives us the contribution margin of the product mix. So we know that for the company as a whole, across the 3 products, my contribution margin is going to be rupees 2 lakh. Rupees 2 lakhs. Okay, it's going to be rupees 2 lakhs. My fixed costs are given to us. If you go back to the example, the total fixed costs are also given to us. Okay, and so the total fixed cost comes to 1,40,000 rupees. And so the break-even point of the, in terms of the mix, comes to, is going to be your total fixed cost divided by contribution margin of the mix. It is therefore going to be 1,40,000 divided by 2 lakhs. And so what this number tells me, that I will break even at 70% of my existing sales as long as I sell these 3 products in these proportions. 800 is to 600 is to 200. Okay. So it's like, you know, if you go to a Domino's or a Pizza Hut and they are selling different types of pizzas, this is how the analysis works. Okay. So as long as I'm selling the pizzas in this ratio, 800 is to 600 is to 200, I will break even at 70% of my existing sale. Okay. I can further convert this number into a per unit break-even point or a break-even point for individual products. So break-even point for individual product is going to be break-even point mix multiplied by units per mix. Okay. So when we think about these three pizzas, we know that the break-even point mix is going to be 0.7, right? Right, it is going to be 0.7. And we know that each mix contains 800 thin crust, 600 hand tossed, and 200 deep dish, right? This is the composition of our overall product mix, right? And so we know now that the total number of thin crust to break even is going to be 560, hand tossed is going to be 420, and deep dish is going to be 140 units, right? So this is the individual product break even point, right? This is the individual product break even point. Fine, right? So now we have calculated the break-even point of a single product company. We know how to calculate the break-even point of a multi-product company. Here, a multi-product company, the only difference is that rather than calculating the break-even point in terms of units, you first calculate the break-even point in terms of number of mixes. Okay. And then you know what are your existing sales, right? So you multiply the break-even point mix by the units per product mix or your units in product mix. Let's make it more explicit. And you will now get the break-even point for, this is my break-even point for thin crust. This is my break-even point for hand tossed. And this is my break-even point for deep dish pizza. All right. So now, as I said, we have looked at both the scenarios, one product, single product company versus a multi-product company. Let us do another example with a multi-product company just so that the concepts are clear. Let us look at this next example. Excuse me. So the problem says that Alphabet Bakery sells 3 cakes, J, K, and L. The following information was taken from a recent budget. The unit sales of cake J are 40,000, K is 120, and L is 20,000. The selling prices for J, K, and L is 60, 80, and 75. Variable cost is 40, 65, and 50. The variable costs are given. Okay. And the total fixed costs for the bakery are expected to be 2,450,000 rupees, right? 2,450,000 rupees. And I want to calculate the number of units of J, K, and L that must be sold to break even. I want to calculate the number of units of J, K, and L that must be sold to break even. Fine. So again, we are a bakery. We are selling 3 different types of cakes. Right. So we know what the selling price is going to be for each of these cakes. Remember, sales minus your variable cost gives you your contribution margin of the individual products for J, K, and L. Okay. Then the contribution margin per unit multiplied by your product mix gives you your contribution margin of the total product mix. The problem tells us that we prepare our cakes, the following amounts are sold. J is 40,000, K is 120,000, L is 20,000, right? So this is our product mix. And so the contribution margin of mix the contribution margin of my product mix, therefore, is going to be 20 times 40,000, 15 times 120,000, and 25 times 20,000, which is total comes to 31 lakh rupees, right? 31 lakh rupees. My fixed costs are 24 lakh 50,000 rupees, 24 lakh 50,000. And so the break-even point of my current mix, therefore, is going to be 0.79032, right? It is going to be the fixed cost of 2450 divided by the contribution margin of my overall product mix of 31 lakhs, right? 24 lakh 50,000 divided by the contribution margin of my overall product mix, right? Now, so what this number tells me is that I break even at 0.79 of my existing product mix, or I break even at 79% of my existing product mix, as long as I sell the products in these proportions: 40,000 J, 120,000 K, and 20,000 L. 20,000 L. Now we know that we can now convert this break-even point of our mixes into the break-even point of our individual products by using this formula. Break-even point individual product is going to be break-even point mix times the units per product mix, times the units per product mix, right? So if we think about BEP for J, it is going to be this number, right, multiplied by we know we sell 40,000 J's, right? This is my product mix, and so this is going to be 31613 units, right? If I calculate break-even point for K, it is going to be the break-even point number times, we know that in our current product mix, I have 120,000 Ks, and so it comes to 94839 units, right? And finally, when we think about break-even point for L, it is going to be And we know that we have a total of 20,000 L's in our product mix. And so this is going to be 15,806. It is going to be 15,806 units. Fine. So now, as I said, we have a pretty good idea of how to calculate the break-even point of a single product company and a multi-product company. Okay, fine. Now we are going to do a little bit more practice. Let me pull out another small example. And I'm going to introduce a simple additional formula. Sometimes, this information that is given to us in units might be given to us in rupees. Okay, it might be given to us in rupees. And so let me just, all right, so let us look at this example 4, where I have a company which is with the following data. And you can see that, unlike in the previous example, I have not given you any per unit data. Okay, I have not given you any per unit data. All these numbers are in rupees. All these numbers are in INR. Okay, the variable costs are also in INR. The fixed costs are also in INR. Okay, right, this is also in. So if no information is given to you related to the per unit costs, how do you calculate the break-even point of this company? Now, if you go back to the summary, I have given you the formulas to calculate break-even point in units. And I have also given you the formulas for calculating break-even point in terms of INR. Okay. And that is going to be total fixed cost divided by contribution margin ratio. Okay, so break-even point in terms of rupees is going to be total fixed cost divided by contribution margin ratio. The contribution margin ratio is nothing but the sales minus variable cost divided by sales. Right, and we know that sales minus variable cost is your contribution margin. Okay, and so this is going to be your contribution margin ratio. Right, fine. And so let us calculate this number over here. Let me quickly. And so this is how I can calculate my break-even point if the per unit information is not given to. Okay, if the per unit information is not given to you, right? So I'll first calculate the contribution margin ratio, which is sales minus variable cost divided by sales. I know sales are 22,500,000, variable costs are 1,500,000, and so my contribution margin ratio is going to be 0.4. And the break-even point in rupees, therefore, is going to be total fixed cost divided by CM ratio, which is 8 lakh rupees divided by 0.4. And so now I know that without getting any per unit information, now I know that I'm going to break even at roughly 2 million rupees or 220 lakh rupees. Okay, I'm going to break even at 20 lakh rupees. Okay, fine. So let me just pull up one more of these examples very quickly. Let's look at this example now. So we have a company which is making a single product for 20 rupees. Okay, all information is in 20. The variable costs are 8 rupees. The fixed costs are 1,20,000 rupees. And my current volume is 50,000 rupees. 5,000 units. Assume that fixed costs do not change. What would be the break-even point sales in INR? Okay. So now we know the formula to calculate the break-even point sales numbers. So we know that break-even point in rupees is going to, or any currency, is going to be your total fixed cost divided by your contribution margin ratio, which is 0.6, right? Sales minus variable cost divided by sales, which is 0.6. And so the break-even point is going to be INR 2 lakh rupees. Now remember, this contribution margin ratio is not an absolute number. Okay, so you can either take all per unit information, selling price minus variable cost per everything per unit, selling price per unit minus variable cost per unit divided by selling price per unit, or you can take all total numbers. Okay, you can take all total numbers, total sales minus total variable cost divided by total sales. You will get the same answer. Okay, the ratio will remain the same, right? The ratio is going to remain the same. The ratio is going to remain the same. Fine. So in just a quick recap, in today's class, therefore, now let us look at one concept which is sort of related to this concept of break-even point, but it is slightly different. I wanted to bring it out, provided that I had sufficient time to do it. The formula is already here. Just let me quickly bring it out for you. Now I don't want to calculate the break-even point of a company. I want to calculate the point at which it is profitable for me to shift from one type of technology to another type of technology. Okay, so this is again an important concept associated with this break-even point type analysis. Let us look at this last example for the day, right? The example says that a hospital is currently using an old X-ray machine and there is a proposal to switch to a newer model. Okay, the variable cost per unit and the total fixed cost associated with the current X-ray machines are rupees 100 per unit and rupees 3 lakhs respectively. And the variable cost per unit and the total fixed cost associated with the new X-ray machine are rupees 80 per unit and rupees 4 lakhs respectively. The revenue generated per patient visit is going to be 150. At what utilization level should the company shift from the old machine to the new machine? Okay, so while calculation and understanding of break-even point is important, this is another related concept that is widely used by businessmen. Okay, see, normally when we think about upgrading our technology, typically what happens is that when we upgrade technology, our day-to-day operating costs come down. Okay, so you can see when I use the old machine, my day-to-day cost is 100 per unit, right? The variable cost. And with the new machine, that 100 rupees comes down to 80 rupees per unit. On the other hand, of course, when you invest in newer technology, the fixed cost is going to grow because the machines can be more expensive and so your fixed costs rise. Okay, so now I want to identify the point at which it is profitable for me to shift from the old technology to the new technology, because remember, the patient is still going to give me only rupees 150 per X-ray. Okay, the patient is only going to give me, irrespective of whether I use the old machine or the new machine, I am going to get only rupees 150 from the patient. Fine. And so I want to know the utilization level at which the company should shift from old to new. Okay, so this is what we call the crossover point. And the crossover point is the is going to be your increase in fixed cost divided by savings in variable cost. Okay. So what I'm trying to say over here is that the shift to the newer technology increases my fixed costs by 4 lakhs. So to 4 lakhs, so by 1 lakh, right? So this increase in cost of 1 lakh should be offset by the savings in my variable cost. The savings in variable cost are 20 rupees, right? And so in this case, therefore, the crossover point is going to be divided by the savings in variable cost. The savings in variable cost is 100 minus 80 when I shift to the newer technology. And so this number, therefore, is going to be 5,000 units. Okay. So as long as you are operating below 5,000 units, we should stick with the old X-ray machine. Okay, we should use the old machine. If demand increases beyond 5,000 units, only then we should shift to using the new machine. Okay, remember, so this 5,000 units is not the break-even point. 5,000 units is the point at which I shift from the older technology to the newer technology. Okay, so I can be a little bit more explicit over here. Crossover point right? So this is going to be the point. Okay, so in this case, given this cost structure, I will shift to the newer machine only if my demand exceeds 5,000 units. If my demand is 5,000 units or below, I will stick to the older machine. And if my demand is 5,000 units and higher, then I will shift to the new X-ray machine. Okay, then I will shift to the new X-ray machine. Okay, fine. Now, all of these formulas and everything has been, I have put it in this session overview, which I will email, and I'm guessing you will receive it from the from our program coordinators. Okay. And so, as I said, just a quick recap. Today we talked about understanding cost behavior, basically understanding what are fixed costs, what are variable costs. And the reason we had to do this is because this cost classification is required for conducting some of the most fundamental analysis before we start any business, which is the break-even point analysis, right? Break-even point, sales to earn desired profit, crossover point. All these analyses cannot be done unless we understand the cost behavior and understand what are fixed costs and what are variable costs within our organization. Okay, fine. All right. So with that, I'm going to end today's session. Thank you very much for attending the session and sitting through these topics. Okay. Thank you.